Welcome to episode 20 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, BTR. Before we get into today's episode, I want to give a big thank you to everyone who listens or watches this podcast. I was blown away by the number of people who, not that it was a ton, but the handful of people who approached me at NMHC's annual meeting in Las Vegas last week, talking to me about the podcast, giving me some ideas and encouragement. Really meant a lot to me and more than I can put into words here. Really does. And then some good news. This past weekend, our podcast cracked the top 100 on Apple's investing podcasts for the first time after just 19 podcasts. So that was pretty cool. And this happened on the same day that we topped 100,000 followers on LinkedIn. So never in my wildest dreams did I anticipate either of those things happening. So super humbling and super cool. And big thank you to everyone for your support, for watching, listening, and reading. Anyway, back to our regular programming here. A lot going on in the industry right now. NMHC Annual Meeting, which is the investment industry's biggest get-together, just wrapped up last week. REIT earnings calls started this week. And we'll get into some of those beginning in next week's episode 21. Plus, a lot of potential changes in Washington, D.C. with the new administration, some discussion on potential impacts of changes in policy around tariffs and immigration. So always things to talk about in rental housing. In this episode, though, we're calling it NMHC Buzz and Midwest Love. We'll be talking about some highlights and takeaways from the annual meeting last week. And we'll talk about the region of the country that the institutional investment community has generally ignored in recent decades, but is starting to take more interest in. And of course, that's the Midwest. And so we'll talk about what parts of the Midwest might be particularly attractive, what's driving it. And for that conversation, I welcome in the CEO and founder of one of the Midwest's fastest growing apartment players, Ivan Barratt of BAM Capital and BAM Company. So lots to cover and going to be fun. All right. So before we go further, big shout out to our sponsor, Madeira Residential. Check them out at madeiraresidential.com. All right, here's a chart. All right, so this is section we dive into data. Before we dive in today, though, it's not going to be a chart. It's going to be some takeaways. I want to give some highlights from NMHC's annual meeting. For those who don't know, I'm sure most of you listening do, but this is, again, the investment community's biggest event. So it's more focused on, investors, lenders, brokers, developers, not as much on the operations side and property management, but still some things on those topics. So I'll cover that there. It tends to be the NAA focuses in the summer, focuses a little more on, or a lot more, I should say, on property management topics. But again, we talk about some high level operational at NMHC as well. So I'll dive into that. Big picture comment first. I would describe the mood as both somber and optimistic. And I know that's a contradiction, okay? But I think it's the best way to describe it. I think about that a lot. It's just the right wording. It's almost like optimism on hold. Confidence that the buy, sell, build environment is going to improve as fundamentals rebound, supply dropping off, demand being strong, rent growth recover, but real skittishness around higher rates. In fact, I was kind of thinking back to the ULI fall meeting 3-4 months ago, and back then the attitude was the sentiment was quite positive. I felt like the world was opening up, rates had dropped below 4%. In terms of the 10-year Treasury yield, I should say. But then Treasuries bounced back up and, away went all that positive sentiment and all that talk about all those BOVs, the broker's opinion of value that was, bubbling up that was supposed to be this big sales pipeline. So a lot's changed. And it's not driven by fundamentals, the economy, or anything else. It's really driven by these higher rates. So let me just recap some themes from NMHC, rapid fire style here. I'm going to go through these quickly, but for a more detailed recap, you can check out my newsletter that went out last week. If you're not already subscribed, you can find it for free at jparsons.com. All right, first thing, lots of short-term uncertainty due to rates, but still a lot of mid and long-term bullishness with strong demand and falling supply. Remember, we have a 50-year peak in supply right now. That's what's pushing rents negative, but completions are trending downhill and should be actually below average by next year. And in some markets, it'll be there this year, but still a lot to work through really over the next 6-9 months. Deal flow, though, is stagnant because of rates. That's point number 2. Again, 3-4 months ago was a different story. It felt like things were getting better, but with rates back in the mid-4s, it creates a math problem because few deals pencil out with higher debt costs unless prices fall, and sellers are generally holding firm on prices. And so buyers really need to see cheaper debt for that to work. And those that are still buying are generally, able to do so at lower cost of capital. Number three, lots of capital is out there, or lots of groups out there are raising capital targeted toward newer assets and bought well below replacement cost. And that's a great strategy. As much as it looks good on paper, though, it's proven very difficult to execute at any scale. There's little of it on the market, and the discounts just generally are not that big unless you're buying in less favored, higher risk markets like Los Angeles or Oakland, et cetera. Point number four, more broadly, there remains a big gap between what institutional capital is targeting and what distress exists or appears to be emerging in terms of future distress this year with loan maturities and whatnot. And a lot of that stuff that's really distressed, we've talked about this in the podcast in past episodes, they're really older assets and less desirable submarkets, often with low economic occupancy and CapEx challenges. So not a lot of institutional appetite for that. Now, point five, though, excuse me, is that I did hear a lot more interest in value add overall. But, I think it's important, value add's a big bucket, right? And it means different things, different people, different companies. For a lot of the institutional firms out there, it's a pretty narrow buy box for what value add really means. They're generally, and again, I'm generalizing here, but high level, the institutions and the larger national groups out there, national regional groups out there, they're really focused on higher income suburbs and good school districts. And of course, few apartment renters have school-aged children. We know that in the market rate side, but school quality tends to be well correlated with demand drivers. And so, submarkets, they always matter, but I get the sense they matter now more than ever. A lot of sensitivity about where you're located. Number six, some capital's looking at new development again. Again, I mentioned this earlier. It's hard to buy well-located Class A right now, the stuff everybody wants. So I think that's actually opening up some eyes to, consider new construction again. Now, I don't expect a big flurry of new starts. Still very few projects pencil out. What does is typically going to be, lower cost suburban garden, quote unquote cookie cutter product. I don't say that to be, to degrade the product whatsoever. I mean, it's still housing. We need it. And it's good quality stuff. But it's much harder to do kind of your, kind of boutique, higher end, high amenity finish outs right now. The challenge is it's a real challenge to build to today's rent levels without subsidies. Rents have fallen or at least been flat for the last couple of years in most markets. Construction costs have obviously increased. Debt costs have increased, and other things have increased. So that makes it tough. And so you got to find ways to build cheaper for that to work. And I think some groups are, but not enough to move the needle back to anything like we just came through. Point number seven, on a related note, banks are getting back in the construction loan game. Definitely not looking to gain exposure, but I think they're looking to maintain it. You see this big wave of projects that's currently going through lease up and stabilizing, the refinancing from construction loans to permanent debt. So, and behind that, banks have very little pipeline. So they're competing again on terms. In fact, we heard that from multiple big developers. Is like they've been surprised to find that banks are competing for their business again. And sometimes one of them mentioned they're hearing from banks they hadn't even talked to in a long time, just looking for business. So now I want to caution that a little bit. Nothing crazy. No one's saying like it's, like the floodgates have opened. But I think in just general point, though, that banks are, out there looking to get back in the game a little bit higher loan to cost ratios we've seen these past couple of years, coming back to normal a little bit. Again, nothing crazy because it came down so much these last couple of years, but the terms are starting to get a little more favorable compared to where they'd been in the last 18 months. Point number 8, regulatory risk is a much, much, much bigger variable than ever in terms of investment strategy and market selection. I heard one group that's trying to find a way to model future regulatory risk that could torpedo pro formas and exit strategies as occurred in places like St. Paul, Minnesota, and Montgomery County, Maryland. Some coastal cities, and by the way, those are spots that enacted rent control and really just, completely changed the investment environment overnight, where those properties become devalued. There's a smaller buyer pool behind it. And even for the new development, even if you exempt it, it does impact the future because there's concern about the slippery slope effect. And so that's a real concern to think about. Some coastal cities, Los Angeles, San Francisco, Oakland, New York City, again, those DC, Maryland suburbs, including Montgomery and PG, Prince George's. Some of them have been redlined by, not all, but some institutions that previously favored gateway cities, both for development and acquisitions. Gateway adjacent, that's the new term right now. Everyone talks about a lot. It's not really new, but certainly more and more in favor. Places like Orange County, California, northern New Jersey, just as some examples, Northern Virginia. These are all spots that are still remain very attractive. In fact, maybe even more than previously, given the changes in the environment for some of the core coastal cities. You still want to be in those areas and similar kind of supply-demand factors, but maybe not as politically unstable, as well as the suburb of some of these big coastal markets. So like I mentioned, Northern Virginia, but also suburban Boston is real popular right now among investors and developers. And also, you're hearing some interest again in the Silicon Valley area, in San Jose area. So eastern suburbs of Seattle as well. So definitely some spots that are still quite attractive, but just may not be the core cities. Number 9, lots of bullishness on the 5-year outlook for the Sun Belt as supply drops off, but demand expected to remain strong. I covered the Sun Belt in depth in another recent episode, so I won't go through this too much, but I did hear a lot about that. Groups that are betting more on the Sun Belt again. There was one panel, a research panel that I was not on, but there was 5 panelists there, and they put together a list of markets that they favor over the 3 and 5 year periods. Worth noting that Dallas-Fort Worth was the only market selected for both the 3 and the 5 year outperformance list. Generally, though, the 3 year list was the markets that have been doing well right now, a handful of Sunbelt markets, but mostly interior and coastal markets like the Midwest and Mid-Atlantic. And then the 5 year outlook is really favored by Sunbelt markets. If I remember correctly, I believe the only non-Sunbelt markets on that group's list were Boston and Columbus in terms of 5 year outperformance. So definitely optimism on the Sunbelt as supply comes back down. And number 10, still a big focus on occupancy and retention and resident experience. This is the operational topic. Vacant units equals zero cash flow, of course. And also on the technology side, continued momentum on the various tech that gives residents and prospects on-demand service, faster solutions to basic processes and requests. All these kind of things, whether it's personal approach, people approach, or a technology approach. Big focus on customer service and on heads on beds. And then one more thing I noticed too is just a continued focus on centralization. This has been a theme for a while, but really trying to take basic processes that have traditionally occurred in the leasing office on site and moving them to a centralized office somewhere. Continued momentum in that area. In fact, we kind of get the feeling that maybe we're even at the point of seeing that those efforts really translate to operational expense savings as well, which has really been the goal. But hopefully we continue to see good momentum because, again, a lot of focus on OpEx these days. All right, so that's my recap of NMHC. Again, you get more details on my newsletter, jparsons.com. All right, so let's shift gears to talk about the Midwest. And so this is today's episode is also focused on the Midwest, in addition to NMHC. And again, I mentioned this earlier, but historically, institutions and a lot of national capital have pretty much ignored the Midwest markets for both SFR and for multifamily. The reputation was kind of, hey, these are slower, boring markets. You don't get much growth. But I think what we've seen more recently, though, is that with the challenges in the coast on the regulatory side, the challenge in the Sun Belt driven by supply, it really drives more interest in the steady eddies, at least as a piece of a national or regional portfolio. So we'll talk about that as we dive in. All right, so first chart here, if you can see it, this is showing you the national rent growth leaderboard for apartments. And this is in terms of new lease effective rent growth, asking rent minus the concession. And 7 of the top 15 markets are located in the Midwest. That includes Detroit, Columbus, Chicago, Kansas City, Milwaukee, Indianapolis, and Cincinnati. Detroit on top at 4%, not one most of us would expect to be at 4%, but very little supply there and good demand, particularly in the market rate, kind of solid institutional grade submarkets. And then also some smaller markets seeing 3+% rent growth in 2024 included Lincoln, Champaign, Ann Arbor, Lansing, Dayton, Omaha, Youngstown, Springfield, Missouri, Grand Rapids, and Akron. And so bear in mind, the U.S. average close to 0% last year, so 3+% is good. Now, one reason for outperformance is a heck of a lot less supply plus steady demand in the Midwest. For those of you who can see the screen, this chart is one I've shown a lot before, and it shows relationship between supply growth and rent growth in 2024. You can see 3 to 5% rent growth in all these Midwest markets I just mentioned. And in all of these cases, supply growth is below 4%. And that's usually quite manageable when the economy is in decent shape, and particularly in older markets with a lot of aging inventory. In fact, and even, that 4% is the high end. I mean, most of these markets are closer to 2% supply growth. Now, compare that to the Sun Belt, where rents are falling slightly to moderately despite very strong demand, but even more supply, with supply growth of 4 to 8% in most of these major Sunbelt markets. And in Austin, it's more than 10% supply growth in 2024. And of course, rents there are falling more than in any other market. And looking at single-family rentals on the scattered site side, it's a similar story. 7 of the top 16 markets for rent growth are in the Midwest or Midwest adjacent. I'm going to lump the Kentucky markets in there, Lexington and Louisville. They behave very similar to Midwest, even if the census lumps them in the South. Lexington, 8.7%. Chicago and Cincinnati, also 8 or above. Louisville, Akron, Milwaukee, and St. Louis, all above 6.5%. So again, similar story on the SFR side. Now, one advantage for the Midwest is just a lot cheaper. And so when you look at the average apartment rents in a major Midwest market relative to an average apartment rent in a major coastal market, you're seeing discounts on average of 50 to 60% across the region. And then, except in Chicago, where it's 39%. And so that's similar to what the advantage of seeing the Sun Belt. In fact, even a little bigger than that. And that's helping. I don't want to overstate this, but you certainly anecdotally hear about people moving back to the Midwest who maybe lived in a coastal city for a while. And it's not like we've taken all the demand out of the coast. There's good demand there too, but you're seeing some of that rebound effect where it's in their kind of home to a cheaper cost of living. And then let's look at the employment market a little bit. The perception is that the Midwest is a home to a bunch of shrinking economies, and at some point they were in past decades. But you look at these past 15 years, some of these markets have really reinvented themselves pretty well. They've become stable and even expanding moderately. I indexed employment in the 10 major Sunbelt markets going back to the GFC at the end of 2009. And the top 10 Midwest markets are all positive again. And I'll let you guess the top 3. It's the 3 that everyone is starting to love right now: Indianapolis, Columbus, and Kansas City. Indianapolis' employment base is up 32% over the last 15 years. Columbus, 25%. Kansas City, 20%. 2 that don't get as much love: Cincinnati and Detroit, both up 18%. And then Minneapolis, St. Louis, Chicago, all 13 to 15% growth over the last 15 years. So these aren't, and then Milwaukee and Cleveland a little below that, but still positive. So, these aren't Texas or Florida numbers by any means, but still very solid, stable, particularly when coupled with minimal supply. And speaking of supply, over the last 15 years, the Midwest has expanded its supply base by only 18.8%, which is the lowest of the 4 regions of the country, slightly below the Northeast and comfortably below the West at 21.3% and the South at 36%. Among the markets, the only one that's really grown supply significantly over the last 15 years is Columbus. And I was actually surprised by this. Supply growth of 40% since 2009. And that's a healthy chunk for sure, but just for some context, it's half the supply growth rate of Austin, as an example. Minneapolis and Kansas City were tied for second at 30% supply growth for the last 15 years. Indianapolis was fourth at 27%, and everywhere else was 20% or less, with Detroit at just 6%. All right, so the result of all this, steady demand, steady employment, but low supply, is that the Midwest tends to offer very low volatility. What I've done here is looked at the 20 years, the standard deviation on rent change of the last 20 years. And what you see is that the Midwest as well as the Mid-Atlantic tend to be very stable regions. It's typically a lower ceiling, but also a much higher floor, where you can see these markets in the top left, if you see my chart, are just markets that don't tend to cut rents very much. And so they tend to be pretty stable. And you compare that to markets in the West Coast, to the desert region, to even parts of Florida, to New York City. Like, these are the markets that can be very volatile. And then kind of your core Sunbelt markets in Texas and Carolinas, as well as some of the other core markets tend to be kind of in between those groups. So last thing, how does this all translate in terms of capital flow? Well, that slow and steady story is increasingly attractive to capital. If you can see my chart, it's showing you the share of all U.S. apartment sales going to the Midwest over the last 15 years. And that share has steadily risen from around 7 to 8% historically. But in early 2024, it reached double digits for the first time in a long time, above 11%. So we'll see if that carries through into the next cycle, and maybe we see more national and regional investors carving out some new or increased allocation into the Midwest as a diversification play. All right, next up, rental housing trivia. Today's question, Montgomery County, Maryland, I talked about this a little bit earlier, recently enacted rent control last year, but it reportedly does not apply to incorporated cities. So here's the question. What are MoCo's two big incorporated cities without rent control? Is it A, Germantown and Bethesda, B, Silver Spring and Aspen Hill, or C, Rockville and Gaithersburg? So this is a little bit of a trick question. I kind of forgot about this until recently, but in Montgomery County, some of the biggest cities are not actually cities, they're census designated places. And so those census designated places, they don't have their own local government, so therefore they fall under the governance of the county. But there are two notable spots that are their own cities, their own, and incorporated on their own, and therefore they're not subject to county rules because they have their own. And so which two are there? It's one of those three groupings is the right answer. So we'll get to that answer in a bit. But first, in the news. All right, so in the news, an ongoing challenge, obviously facing home builders right now is tariffs. And so we have a letter from the National Association of Home Builders that came out January 31st, and they're asking the president to basically exempt home building materials from tariffs. They point out that builders rely on materials from Canada and Mexico. They represent nearly 25% of building material imports. And that's going to be passed down in terms of higher home prices and likely rents as well for new construction. So this is a big deal. There's been a lot of news on this week. It appears like these tariffs for Canada and Mexico are going to be paused for the time being, but certainly something that builders are watching closely and could further complicate the math for apartment construction should that go through. It doesn't move. These aren't massive numbers, but they're enough. This is a tight margin game, so it does still matter. Next up, here's a headline from the Washington Post. It says, D.C. sues landlord alleging discrimination against non-voucher holders. In a first-of-its-kind lawsuit, the D.C. Attorney General's office accuses developer of skirting rent control by renting only to voucher holders. And it just reminded me of a headline from a few years ago that came out, same city, Washington, D.C., and it says, D.C. real estate companies to pay landmark $10 million fine for discriminating against voucher holders. So yeah, property managers getting sued for allegedly discriminating against voucher holders and allegedly against non-voucher holders. You can't make this stuff up. And no better way for a city to say we need more supply than to sue instead of find ways to collaborate with housing providers. Next headlines, CoStar. Wildfires placed 9,500 rental units in peril, exacerbating Los Angeles housing crisis, consisting mostly of older, smaller stock. Destroyed multifamily units face difficult rebuilding odds. All right. So I don't know if it's going to be fully that 9,500 apartment units. I think they're just trying to estimate the number of units in the affected areas. But it's going to be fascinating to see how or if some of these units get rebuilt. Especially likely having to be rebuilt at the same rent levels. A lot of these are older units, are subject to rent control, which is anything built prior to 1978 in Los Angeles area. And it's just impossible construction math absent very, very, very large subsidies. Even if property owners get insurance checks, you got to think that they're still going to have to pay quite a bit out of pocket to rebuild and meet the various requirements. So on the one hand, it's encouraging to hear LA and California officials talk about streamlining the rebuilding process and permitting, et cetera. But on the other hand, it just may not be enough to justify reconstruction of some of this affordable housing. So hopefully the city and state find a way to make it happen. All right. Next up, off topic. All right. So off topic is a new segment in the podcast, and the first time we've covered it. My colleague and asset manager extraordinaire, Chris Housewright, had the idea for this segment when we first started the podcast last fall. And the idea was that Off Topic was a chance to briefly opine on a subject outside of real estate, but with the same data-minded approach. But it took me 20 episodes to find the right content to talk about for Off Topic. And then living here in Dallas, the news of the Dallas Mavericks trading away generational star Luka Doncic to the Lakers is an obvious fit for our very first off-topic segment. So there's a lot of people asking, is this the worst sports trade of all time? At least those of us in Dallas. There's been protests in Dallas. There's a mock funeral at the Mavericks arena. Nate Silver, the stats guru, formerly at 538, he compared it to the Boston Red Sox trade of Babe Ruth to the New York Yankees. Both cases are very young stars who hadn't yet reached their prime, at least in terms of their age. And me being in Dallas, I'll tell you, it was a hard day having to tell my sons what happened. They loved watching Luka in Dallas, and I'm sure every Dallas area parent can relate to that. And so there is one comparison that I haven't heard a lot of people talk about until my father reminded me. And that is the 1959 Cleveland Indians. All right. So there's an outfielder named, let me tell you about the story about a guy named Rocky Calavito and the curse of Rocky Calavito. All right. In 1959, Indians outfielder Rocky Calavito led the American League in home runs. Now, he wasn't a phenom to Doncic's level, but he was a rising star, face of the franchise. One game, he had 4 home runs in a single game and single 9-inning game. Became only the second AL American League player to do so after a guy named Lou Gehrig, who you may have heard of. And then after that 1959 season, akin to Luka taking the Mavs to the NBA Finals last year, the Indians traded Calavito away to the Detroit Tigers. So what happened after that? Well, the Indians finished 1960 with a losing record. Maybe more impactfully, they lost, their attendance dropped off by more than 500,000 fans. Meanwhile, Calavito became a star for Detroit, later went to Kansas City and did the same. And then the next couple of years, attendance in Cleveland dropped off by another 400,000 fans. And then in 1965, under new leadership, the Indians tried to reverse their fortunes by trying to bring back Rocky Calavito. But at that point, it was too late. And it turned out to be another lopsided trade in the wrong direction for Cleveland. One of those guys the Indians traded away was a young pitcher named Tommy John. And for baseball fans, yes, that Tommy John, who later became famous for being the face of the arm repair surgery that bears his name and has now become commonplace throughout baseball. He pitched for 26 years and won 288 games. The Society of American Baseball Research estimated that the 2 Calavito trades ended up costing the Indians about 50 wins in the 1960s, using Baseball Reference's wins above replacement metric. So there you have it, the curse of Rocky Calavito. And for Dallas Mavericks fans, let's hope that the Luka Doncic trade does not lead to a disaster like the Rocky Calavito trade did, leading to years and years of irrelevance. And hopefully, in the decades of the future, we're not talking about the curse of Luka. All right. So that brings us back to rental housing trivia and our answer. Today's question was, again, Montgomery County, Maryland recently enacted rent control, but it reportedly does not apply to incorporated cities. What are MoCo's 2 big incorporated cities without rent control? Is it A, Germantown and Bethesda, B, Silver Spring and Aspen Hill, or C, Rockville and Gaithersburg? And the answer is C, Rockville and Gaithersburg. So again, what's a surprise maybe if you don't know the area very well is that Germantown, Bethesda, North Bethesda, Silver Spring, these are dense urban areas, but they're not actually cities. They're census designated places. So they're subject to the governance of the county. Rockville and Gaithersburg, however, are incorporated cities with their own local governments, and therefore they are not subject to these rules. Now, there's been a push to get rent control enacted, especially in Rockville, but the current city council has pushed back against that and appears to be more focused on proven, more viable solutions to housing affordabilities that do not choke out supply. So hopefully that sticks. All right, so let's jump back into talking about the Midwest by jumping into the interview portion of today's podcast. I'll be welcoming in the founder and CEO of one of the Midwest's fastest growing apartment owner-operators, Ivan Barratt of BAM Companies. BAM ranks in Inc. 500's list for America's fastest growing private companies under Ivan's leadership and is active across a number of Midwest markets. All right, now go into the interview portion of today's podcast, and I'm thrilled and honored to welcome in Ivan Barratt, the founder and CEO of BAM Capital. So, Ivan, thanks so much for being here.
Thanks, Jay. It's good to see you, man.
Good to see you again. So,
about time we recorded one of our conversations.
It's enough of them offline. We should give. I want to give the good people here a better picture of everything you're doing at BAM. So one of the things I love about your story is I think you've done what a lot of groups want to do. And so I'd like, if you can, to share some secrets here. You started off as a property management company, evolved into owner-operator, buying apartments, managing your own, then evolved further from a deal-by-deal syndication model to a fund model, another big jump. And now I saw you rank in the Inc. 5000 for America's fastest growing private company. So congratulations. And what's been the secret to the growth?
Well, as we were saying before starting the call here, we could spend a whole podcast on that, right? I wouldn't say there's anything too secret. I mean, thank you for all the accolades. I feel pretty lucky. We started that first, not because I was wiser or smarter than anybody else, but I had this feeling that I needed to figure out the execution side of the business before going big. And I'd been in property management a few years. We're going into 2013, 14, got some apartments, a lot of single families, duplexes, condos, all kinds of stuff. And I was, banging my head against the wall, and employment was a merry-go-round, a turnstile of people coming in and out. And really just had this question, like, what would it take to have a management company where people liked their jobs? What could that possibly look like? And luckily enough, I found some early adopters of that, some really key hires that took that proverbial baton and helped me run with it. And we put a lot of focus on culture and executing on that idea of having a company where people actually like to work and wanted to sort of bang on our door to be part of it. And so we spent a lot of time on that early on, certainly made a lot of mistakes along the way. But it's continued to grow. We focus a lot on culture and taking care of our people. For us, it's funny. I was in a discussion with a bunch of CEOs in our space, and people are debating, in-house property management versus third party. And I heard these things from operators: necessary evil, source of all my problems, my biggest headache. And I think, it really starts with mindset. Problems are a good thing in business because the more problems you uncover, the more you can solve and grow and be better. And for us, management is a beautiful machine of humans who are responsible for executing our wealth objectives for us and our investors. And so we couldn't imagine doing it any other way. It doesn't make us a lot of money. If we were very miserly with how we operated that company, we could eke out a profit margin maybe akin to a restaurant, about 10%. And instead, we take that 10 or 15% in some cases, and we reinvest that in our people. We've got a conference every year where everybody comes in from every property. We spend a lot of money on that, spend a lot of money on our Christmas party, quarterly events, and an old school style family reunion every summer, old school cookout kind of corporate event. And we find all these ways to bring people together, to help educate them, to help them grow. We spend a lot of time on core values. We believe very strongly in people, and when people grow, BAM grows. And it's anything but easy. It is not complex. It's not rocket science. It's just really hard to pull off. And when I hear these things in my peer circles about necessary evil and the source of all my issues, I get a little twinkle in my eye.
That's great. So I thought you'd have anything but talking about basics, people taking care of problems, but you attribute just that foundational approach to growing into an owner operator, training capital. It all comes back to having good people and taking care of them.
People is so much a part of it. Don't share this, just between you and me, but when you pay people well and you take care of them, they tend to stick around, do a better job, and tell maybe a friend or two about how they're treated.
All right. Well, we won't tell anybody besides the few thousand or so who listen to this. So whenever I post, one of the ways you and I got to know each other a little bit is whenever I post on LinkedIn about the Midwest, you like to jokingly tell me to stop telling people about it and to keep the Midwest success a secret. And some others do too. And even though it's a joke, I always find it really interesting because nobody in the coast or the Sun Belt tells me that. They like to talk about how great they are. The Midwest tends to get overlooked in those debates. So my question to you is, why do so many investors, both GPs and LPs, tend to overlook the Midwest?
I think I have the benefit of being born here, and I know we've talked about others that are from the Midwest that invest elsewhere. But growing up here, going through business school, and seeing these changes, especially in the great state of Indiana and in other Midwestern jurisdictions, you saw these early green shoots, this trend with a lot of momentum behind it, successfully decoupling from the Rust Belt moniker of the 40s, 50s, 60s, 70s, and 80s, where manufacturing is being hollowed out, right? And what you've seen in these markets is diverse employment in financial services, life science, education, government, and several other sectors, including in many cases technology, to where now you've got these world-class suburbs with steady eddy growth rates of jobs and population, with safe schools, affordable housing, wonderful downtowns. It's really fun to watch. And then for all these other reasons, you've got larger investors chasing sexier, shinier objects around the country. Sets up for a wonderful value investment play to where I can buy great assets for a fair price and have a high conviction of increasing or enhancing that asset's value through various ways, versus chasing the same assets that many larger investors are chasing. Um, Now, those are great deals in some cases, but they're not getting the returns that we've been able to achieve. And so it only makes sense for us to seek out value. And we're just lucky to be here in the Midwest area and sort of see it up close.
Yeah. Yeah. You mentioned some of the downtowns kind of sort of anchors some of these metropolitan areas. And I tell people all the time, I think some of these Midwest downtowns are some of those underrated parts of the country. I love downtown Indy, Cleveland, Omaha. I mean, just name a few, make you on the list. I mean,
Well,
they're
let
just,
me and let me just correct a little bit. Well, some of those downtowns are doing well. Some of them are struggling.
yep.
What I would more refer to are the suburban cities, the Carmel, Indianas of the
Yeah.
world that have successfully developed their own downtown or urban centers, and then they've also got the safety and the schools and the jobs, and that paints a really great picture for multifamily.
Absolutely. And I agree with you, by the way, in the suburbs too. I just think sometimes having a good, solid downtown helps the
Absolutely,
entire metro area, including those suburbs where, obviously there's going to be more apartment investment.
for sure,
Uh,
for sure.
so you alluded to this, but there's plenty of Midwest GPs we both know, based in the Midwest, who invest heavily in the Sun Belt and not so much in their own backyards. And we talked to them privately. A lot of them told me it's just harder to raise capital for a Midwest strategy. So, kind of building upon what you just shared, how have you found success selling investors on the value of the Midwest?
That's pretty easy. The returns speak for themselves.
Yeah.
We just had our 14th exit. Our average IRR has been a 35 handle on a 5-year hold. Um, Excuse me, a 35 on a 3.5-year hold,
Wow.
and almost 2.5x multiple of investment. And so we've returned well over 200 million out to our investors. So those early full cycle deals helped a lot with the momentum of repeat investment, new investment, referrals. We also got a lot of early adoption in Southern California. Many of our early management clients became some of our first syndication investors. And there were a lot of Californians that liked the Midwest story.
Hmm. Yeah. Well, that's great. I mean, yeah, returns speak for themselves. So that's an impressive story. All right. So just playing into your wheelhouse here for these last few years and probably again in 25, we've seen the value of the Midwest playing out, the steady eddies. Didn't see, the Midwest doesn't see these crazy growth numbers. We didn't see that during the pandemic, but we also didn't see bad numbers. We didn't see crazy numbers on either side of it. It's been that steadiness has played out. Today, the Midwest dominates the national rent growth leaderboard with very sustainable rent growth numbers in the 3 to 5% range for the most part. And with that, we have seen some more capital getting interested in the Midwest, even at an institutional level. So I'm curious to ask you, as somebody who plays in the Midwest all the time, is how is that increased profile and increased institutional interest impacting deal activity in your markets, particularly your bigger markets like Indianapolis and Kansas City?
I'll take Indianapolis. There's certainly periods here where I can't get a deal done. Where larger investors are coming in and they're just willing to take a lower return and pay a higher price than my strike. Again, I've got to pay a fair price for a great asset and have that high conviction that I can enhance NOI. And so oftentimes we will exit that secondary market or put it aside for a while and go after the tertiary markets where we know we can still find value. So Indianapolis definitely seems to be back on the radar of a lot of folks. Columbus, Ohio, certainly getting a lot of credit with some of the chip manufacturing, and now Anduril coming in with a large injection of jobs. And so here, like anywhere else, you will get these periods where the bid of the larger institutional type investors pushes us to find value elsewhere.
Yeah. So speaking of elsewhere, obviously BAM's operating heavily in the Indianapolis metro area. Also, you're in Iowa, Illinois, Missouri, Arkansas, Ohio, Pennsylvania. So other than KC and Indy, I describe most of your markets as secondary or tertiary, at least on national definition. Obviously, it's subjective definitions. But what markets are you finding especially strong right now?
Well, I'll bare my soul on a lot of things, Jay, but talking about markets, well, I think this year it's still sort of a toss up. I'm sure we're going to get a lot of good information out of NMHC. I think transaction volume should start to stabilize and increase. In 2023, we were buying deals in Indianapolis, and we were the only bidder at the time,
Wow. Yeah.
which was a fantastic time to buy. I would not be surprised this year if we're more in the tertiary markets of some of those states, which is. You got me wanting to tell you some of those markets, but I'm gonna bite my tongue, Jay. Keep those markets to myself. But they're out there. Our audience, those who are operators, know how to find those markets. There's some great smaller cities here in the Midwest that are growing above the national average, and supply is in check. New supply is in check versus the market. Whereas some of these larger cities, you're seeing a lot of increased supply, and we know that that'll burn off eventually, you and I. But in the meantime, we've got to find ways to make value now.
All right. So I don't like giving too many secrets away, but can I ask, are there any markets you're not in today that you're looking to expand into? Anything particularly intriguing to you?
I've got a really great acquisition team that runs out in front with the brokers, and I'm sure if I had one of them in here, they'd give you a couple sweet nuggets of markets we might be interested in. If I had to guess today and look at my crystal ball for 2025, my hope would be that we are continuing to scale in markets that we've entered in the last 18 months, such as Kansas City, Pittsburgh, Pennsylvania, and those suburbs. Maybe another deal in Rogers, Arkansas. That's a small city that's growing like crazy. Walmart's really starting to pick up the relocation strategy for their corporate headquarters. So in general, we'll still be doubling down on what we like, which are those secondary and tertiary markets throughout the Midwest. We're suburban garden guys. We're looking for those Class A suburbs with great schools, great safety, and a diverse jobs picture.
Yeah. 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 Certainly Northwest Arkansas is one that's definitely growing in profile for some of the reasons you mentioned.
Oh yeah. No secret shared there. It's out.
Yeah, yeah. I've always seen people always debate, these kind of silly social media debates, like, "Hey, what's the next Austin?" It's like, "Oh, it's Northwest Arkansas. It's one of the places you'll pick." It's going to be a while before
we'll
it's
see
Austin.
about that. We'll see about that.
It's a beautiful area though, too. All right. Well, we're doing well on time. So I want to ask you another kind of random question here. Is you went viral last year for a post on meeting Jamie Dimon. And it was pretty cool. And some of the lessons you pulled away, you posted on this. You had, I don't know how many thousands of people who liked that post. But do you mind tell us a little about meeting him and what you took away from that conversation you got to have?
Yeah, I usually avoid those after hours business networking events. But my banker calls me and says, "Hey, Jamie Dimon's coming to town. Would you like to attend?" And for me, like I said in the post, that's like meeting Michael Jordan or Kobe. And I happened to walk in about 5 minutes early, and he's standing right by the door talking to a couple people. And I had heard that he runs a lot of his organizational uh, delegation, team strategy, what he's handed off on a sheet of paper. And so I asked him about that sheet of paper. And I try to follow whatever Jamie's talking about. I have a lot of respect for the guy. But that night he lit up and told me all about that. It's full of chicken scratch, but it's all about what he's given his team, what he's asked for from them, all the deliverables they owe him. And it was just a humbling reminder that sometimes it's not finding the next tech stack or finding, the next hack on growing a business. It's just simple, fundamental basketball in a lot of ways. Similar to our basketball state here in Indiana. Um, he's talking a lot lately about inflation. I am fairly in line with what Jamie said, that most roads lead to inflation. There's inflationary forces in the U.S. that aren't going away anytime soon. Rising labor costs, reshoring of manufacturing, a multipolar world, all these things that are changing the very fabric of our landscape, and we're leaving one age of that post World War II dominance to a multipolar world that'll be very different than the one we're exiting. And it's fun to watch. It can be a little scary, but there's also, I think, a lot of opportunities. And in every circumstance, many people will need a roof over their head.
Yeah. Yep. No, I tell people all the time. I say you could shop from anywhere, you could work from anywhere, you could buy food from anywhere, but you need a place to live. So apartments provide that.
You need a place to live. And I don't see the Midwest slowing down anytime soon. I think there's a lot of steady forces, steady trends that are pointing the Midwest in the right direction.
Yeah, it's interesting anecdotally. I'm sure you see this since you live up there, but I'm in Texas. You're in Indiana, and I hear so many stories about people who grew up in the Midwest, moved out for stage of life,
Sure.
and in past generations may have stayed wherever they relocated. But you hear stories you'll move them back because they're able to have some flexibility in terms of where they work, or maybe there's better jobs now available where they're going in the Midwest. So it certainly seems, obviously not every Midwest city is the same, but there certainly seems to be an increasing bull case for the Midwest in this next couple cycles.
Yeah, Indy, I'll try not to screw this up. I just read this morning. Indy now was number 8 on the list of one-way U-Haul trips into the market as a leading indicator of in-migration. Number 8.
Yeah, that's great. I tell people all the time, I think Indy is like the most Sunbelt-like Midwest market, meaning like younger population. It's a stronger job base. You look at just demographic characteristics, it behaves a little more like a Sunbelt market than some of the other Midwest cities.
What markets are you looking at outside of Texas?
Well, the places that we're looking a lot in the Southeast, but if I were going to the Midwest, I love obviously your town of Indianapolis, love Columbus, Ohio. I think that's going to be a growth market. Obviously, others think the same. That's another hot market for buying right now. Kansas City, and then one that I've been bullish on for a long time on the smaller market side is Grand Rapids, and that one's seen a lot of growth. And certainly not really a secret about those who operate in secondary Midwest markets, but that's another one that's got a lot of great demographic and employment drivers in that one.
I'll second that. Grand Rapids would be a market where we're underwriting assets and looking for opportunities.
Yeah, and I think there's a case. I mean, I always say it all the time. It's like, and this, like any market, you can find the right deal and right opportunity. Cleveland is one, like just to throw an example. It doesn't have the best, headline stats on anything, but there's some great parts of Cleveland that I think people can do really well, and they can make the same case on other markets as well.
Well, and that's the trick, right? If we're always chasing the hot thing, that it's going to be difficult, if not impossible, to make those returns to keep investors coming back.
Yeah, absolutely.
Yeah, we've got to sort of look where the baby's getting thrown out with the bathwater.
Yeah. You see, it's finding opportunities, right? I mean, what's getting ignored? So all of a sudden, there's value you can't find elsewhere because of the function of less buyer competition.
Couldn't have said it better, Jay.
All right, so just to close us out, what's next for BAM? What's on your radar for these next few years? How will you continue growing?
Well, like on a macro level, it's how do we continue to do this thing at a higher level? How do we continue to scale really, really well while maintaining the culture that we've created? So protecting that culture we have on the management side that is really, really humming along. In the last few years, we feel pretty blessed to raise about 100 million a year, a little over 100 million of equity deployed.
It's great.
Certainly put a lot of our own capital to work to get all the opportunities that have been coming. And so now it's just continuing to double down on that and expand our ability to meet new investors and build trust and build relationships so that they invest alongside us. And so it's not really anything new or earth shattering. We've got 3 strategies now. We joint venture with the developers. We've been at this income fund model now for, going on 5 years, I want to say. And now we've transformed that income fund into an evergreen vehicle so that it can continue on the most efficient manner possible. And then that dovetails with our acquisition strategy at the fund level. So Fund 4, we're getting pretty close to wrapping that up. Fund 5 will be next. They tend to be a little bit bigger as we go. And so continue to incrementally grow the company. You mentioned the Inc. 5000. That's 7 years now in a row that we've made that list of the 5,000 fastest growing companies. But more importantly to us, it's those accolades we've been getting in culture and best workplaces. That's really how you grow something special. And if other big companies can do it, we can certainly figure out a way to get there as well.
All right, so I got to ask you one last question. You mentioned closing the raise on Fund 4, going into Fund 5. I mean, even though you're in better markets in terms of growth right now, revenue growth right now, rates are what they are. GPs have a hard time raising capital these days. I mean, is it still tough, even though you're in better performing markets?
I have spent more time and more resources to raise 100 million than I thought I would. It's still tough. I'd like to think that we do it better than most and that we have a wide audience, a big pool of investors to raise from. The RIA network has been very good to us, putting the infrastructure in place to service wealth managers, being on Charles Schwab, being on Fidelity, being on these other platforms that are not easy to get through the due diligence, rectal exam that's required. But to bring in those wealth managers alongside of us and to be a partner with them has helped accelerate that capital raise, and maybe some institutional announcements in the near future.
Oh, okay.
Still sticking to our tried and true retail platform. We've got well over 1,400 investors now. I think our smallest check is 200,000, and our biggest one is somewhere around 15 million.
That's great. Well, congratulations on all the growth, and it's a success. And thanks for spending some time with me today.
Yeah, anytime. It's good to be here, man. Thanks for having me.
All right. Thanks again. And that's a wrap on episode 20 of the podcast. Big thanks again to Ivan for joining us. Thank you for all of you for spending part of your day with us as well. And join us next week as we start diving into earnings call season for the apartments and SFR REITs. Hope to see you then.